everybody, and welcome back to another episode. I'm your host, Brendan Cobb. Today, I'm excited to have Randy on the podcast. Randy is the founder of Impact Equity. It was formed to help investors achieve strong results in their passive real estate investing strategies. Randy and Impact Equity, they have helped over 70 investors place multiple millions of dollars in 8 different opportunities since launching in June of 2022. Randy, that's a lot of scaling that you've done there. I'm excited to talk about your story a little bit more. For those that don't know you, give us a little context on your background and how you got into what you were doing today.
Yeah. Thanks so much, first of all, for having me on the show. I appreciate that. And I'm thinking that the bio I gave you is a little bit outdated. So we'll get into that, I'm sure, a little bit in this recording. But yeah, I was a career sales guy, spent 25 years in corporate America, and ended up being on the wrong end of the stick of a couple of layoffs throughout that 25 years, which kind of planted that seed in my mind that I needed to be doing something other than just stocking money away in the 401k and doing IRAs and maybe buying some stocks. I needed something that would decrease my dependence on my W-2 in the event that another layoff might come in the future. So about 6 years prior to my last day in corporate America, I started investing in single family homes out of state. I bought a couple of turnkeys in Kansas City. Then I did the BRRRR strategy in Atlanta on a bunch of properties. And I found out pretty quickly I was not going to be a single family guy long term. It was just, the phone calls, the unexpected expenses, all of the challenges you hear a million times in that space. I got to experience those firsthand. And that's when I found passive investing. So shifted very quickly over to passive investing very heavily, and using a diversification model, trying to diversify dollars across multiple operators, multiple asset classes, multiple deals, and different geographies to make sure that the ebbs and flows of my income that I was getting were not dependent on any one facet. So, fast forward to May of last year, got laid off once again. And made the decision to start educating and inspiring people about this passive investing space, because my efforts in that space allowed me the ability to not have to go back and get another W-2 because most of my expenses were covered from passive income.
So you had started investing passively, had built up this machine, and so it wasn't all doom and gloom when you got laid off for the third time.
Yeah, it was. Yes. So in my organization, I worked for Fortune 100, Fortune 200 companies for the last 20 plus years. And me and 400 of my colleagues got laid off. And it was a different experience this time from the time I had been laid off 10 years prior, because I knew at the beginning of the month, the majority of my household expenses were going to be covered from passive income. Now, my colleagues, though, had not gone down that path, and it was, it was a hard time to watch those folks scurrying, trying to take any job they can get, just pick up something so they could keep getting that paycheck every couple of weeks. So,
yeah, it sounds like y'all got hit by that, the round of massive layoffs from the impending recession everybody was kind of predicting. What sector was it in?
So it was financial services and the banking and credit cards specifically.
Okay.
So one of the largest credit card brands in the world. And they have a tendency of knowing, because they see transaction volume and they see debt trends and how people are paying those same bills, they kind of get a peek into the future to know before everybody else knows. So they have a tendency to start doing layoffs before the big wave hits. And that's what I saw for the last 20 years, that there would be ups and downs in the economy. And when it was going down, you'd see huge amounts of people laid off. And it didn't matter whether you're a performer or a non-performer.
Yeah.
If you just happen to be in that division and on that Excel sheet, you're gone, So it's a scary place to be if you don't have other options.
So when you made this transition, you got laid off for the third time. Obviously, there was something different about this layoff compared to the last ones, because you chose not to jump right back into the job market. You said, hey, let's give this entrepreneur thing a shot. I've been a passive investor in these real estate investments. You now said, hey, I want to make the decision to go active, which is a great thing. Like you followed that sounds like the perfect strategy that like I would give somebody as advice, like, hey, do your job, jump in. And then, for me, kind of similar to you, I got fired. I got let go from my job, but didn't see it coming. I was kind of forced into it.
Sure.
But that's what would have worked for me. I don't know that I would have ever had the wherewithal to do what you did and actually start without kind of the rug being ripped out from underneath them. So that's great that you get to experience that. Talk about some of the asset classes that you're focused on, right now. What is really interesting to you?
Yeah. So interesting or dependable aren't always the same thing. So I think that's a great question, because just like in any investing journey, you've got to have diversification and you have to have some type of strategy that you're approaching. Now, I like multifamily. I think the fundamentals for multifamily look very strong. I think they will continue to look very strong for the foreseeable future with the affordable housing issues that this country faces. So I hold about 65% of my personal net worth in multifamily syndications. And I have other interesting things where I place capital for different reasons. I've placed some capital in an ATM fund because it's just a fantastic cash flow opportunity. I've got some dollars in self-storage because I think it's much more stable and does very, very well during recessionary periods. I like simple, easy businesses like wash your own car, 5 or 6 bay car washes. I've started to invest in that space. Mobile home parks, as you mentioned earlier, again, very recession resistant. And I don't have any yet, but I am starting to look at industrial more and more with the reshoring trend that we're going to see, I think, in the coming, 5 to 7 to 10 years. I think industrial will become more and more, even warehousing will become more and more of a need and an asset class that I think we're all going to want to know more and more about. So that's kind of what I'm doing today.
So you've got this broad knowledge across multiple sectors. I'm very interested because you started last year and you've already done, correct me if I'm wrong, is it 8 total deals that you've done?
So 11 deals at this point.
So 11 deals. Okay. So you've done 11, and these are, apartment complexes, mobile home parks. I mean, these are pretty big deals. There's a level of sophistication here that someone coming out of a W-2 is kind of like, would just be overwhelmed by. How did you go about building your knowledge base in these different asset classes that ultimately led to you being comfortable to really scale? Because you've scaled quite a lot in just 1 year, man. I mean, congrats to you. That is just absolutely exceptional, the amount that you've been able to do in just 1 year.
Yeah. So I think a couple of different things that are probably important. One, I didn't start the education journey just a year ago. I started the education journey probably closer to 10 years ago. Okay. And I was a sales guy for a lot of years, and I had a lot of windshield time. So I listened to it. I listened to a ton of podcasts. I listened to a ton of books.
Yeah.
Yeah, I spent a lot of hours on the road. So I was researching all of that time. And when I first jumped into the space, I made the decision because I'm a big brand guy. I like large organizations working for Fortune 100, Fortune 200 companies. I like well-established brands with deep resources, deep benches, expertise, and longevity. So I started, at least initially, looking at some very large brands for my own investment dollars. And that I made the decision to do that because I felt if I was stepping into somewhat what I considered at the time riskier investments outside of the stock market, I now don't believe that. I think they're probably more safe than the stock market, as we've seen in the last couple of years here. But I thought it would be safer to put my dollars in large, well-known brands that my belief was they would have a harder time not providing the returns or creating a negative customer experience or investor experience. So that's where I started investing. As I became more skilled of an investor, I started to niche down into specific markets that I was more interested in. And I started to build relationships with larger operators. that over time I built my trust with and started to put small dollars into those investments. And then as the performance improved, I just added more and more dollars. So it's been a very long process. But where I am today is I basically have 3 partners that I work with, that I've vetted, that I've invested with, that I've experienced with, that I've been watching for years. And I trust them with my own dollars. So I trust them with my investor dollars as well.
Mm-hmm.
And I find once you vet an operator, more often than not, they are going to, or the type of operators that I like anyways, they have the tendency to kind of mix and repeat over and over. Very cookie cutter, very boring, just same thing, singles and doubles, down the fairway type of investment. So I don't like to see operators that try to do a bunch of different things, because while I think it's fun and exciting, I don't like fun and exciting for my investment dollars or my investor dollars. So I like boring and pretty straightforward stuff. So
I was on the phone with a guy the other day, and he was like, "Dude, I've just, I've got this. I'm just like itching. I want to grow my concrete business, and it's like, should I start like a mastermind, or should I do this and that? Because like it's going so well. Like, should I go into other markets? Should I expand?" I was like, "You've made how much money doing commercial concrete jobs and residential driveways and sidewalks, dude? Success is boring. Just keep doing what you're doing."
Double down.
He's bored at what he's doing, and he's a young guy, and he's absolutely killing it. And he just, I guess he feels the need to have some kind of excitement or some kind of like adrenaline rush with a thing of something new. And I'm like, dude, just success is boring. Keep doing what you're doing. So you started this journey 10 years ago in your job. You started investing passively. You identified, the bigger name guys. You started small with your investment, slowly kind of built a relationship with them based on the performance, kept reinvesting, kept growing it. And that's kind of how you learn. And then you were blessed to be in this role where you had a lot of drive time. I did too. I can't tell you, if you're a sales rep out there and you're not listening to tapes and books and educating yourself on these drives, it's a free master's education. It's just free out there. Huge. So you got to be doing that. And that's how you built your foundation that you needed, that eventually kind of catapulted you. And it was like a spring. I mean, you were ready to go out on your own at that point.
I definitely was. Yeah. And I think that, the active guy in me who went and tried the single family stuff, I found out real quickly, I was not an expert at, fixing toilets, rehabbing houses, doing any of that stuff around the single family stuff. And it became very, very apparent that I needed to find experts at what they do and trust my dollars with them, versus me going out there and trying to do it myself. Because, guys that have been doing this for 20, 30, 40 years, there is no way that some weekend warrior is going to be able to come in and have the same type of results that they do. So I think it's really important to trust the experts and let the experts do what they do. I'm a huge fan of who, not how. And if I can find somebody to do something that I don't like doing, or I'm not an expert, I'm going to do that all day long.
Now, so you've been doing this for, over a decade, and you've put your money where your mouth is, and you're now doing it actively. Where are you currently looking to place your capital and your time and effort right now? Like, which asset classes are most attractive to you?
Yeah. So right now, I, again, kind of stick with my strategy of about 65% multifamily.
Mm-hmm.
And then I have this other 35% of dollars that I play in other areas. But I like value add multifamily primarily as a wealth generator over time. It's not a great cash flow mechanism, not in the Sunbelt markets where I primarily invest. So I like multifamily value add for wealth generation. And I've started to play and present short-term rental fund to my investors, which is a really strong cash flow play. And I think in the future, we're going to see a lot of interesting opportunities come up with debt funds, with everything that's going on with all of the floating rate debt that's out there. I think there's a lot of opportunity to It depends on how you look at it, but I think there's opportunity to come in and really save the day, where we can protect some investor capital and save some operators that should not have been operating in that space in the first place. But I think debt funds will be a big opportunity in the future.
Now, the big question everyone's asking is the future of multifamily, because interest rates have, nearly doubled. There's a lot of distressed opportunities that are out there. We saw, a pretty big portfolio in Texas that ended up getting foreclosed on. I think it was a hotel in San Francisco, made headlines. What do you make of, like the future here? Are you kind of on pause waiting for these like distressed opportunities to come to light, or are you still finding deals today that are penciling?
Yeah, great question. And it seems like it's almost it's a week to week trend that seems to be changing here. I think we just heard this morning, I'm not sure when this is going to air, but the federal government got downgraded to a AA+ from a AAA rating, which I think there's going to be some impact on that. I was thinking this morning, just when we think we're starting to see some positive stuff, something out of left field comes, and this could have a big impact on the whole arena. Yeah, I don't know. I think we're starting to see more deals come onto the market. I'm hearing from my local network that more deals are starting to pencil. I think that gap between seller and buyer expectations is starting to get smaller. And that could be a function of, some, we're hearing different things, like people are having to turn deals, whether it be their lending requirements are requiring them to do that, or I've even heard on a recent deal where Blackstone is having to sell some assets because their investors are asking for their money back. So that's driving some decisions. But I think we're going to see through the second half of this year, I think we're going to see transaction volume start to move back in the direction that we want it to. I think estimates are that it's down 75% the first half of the year compared to last year and the previous year. So things were pretty quiet for a handful of months over the last 6 months. So I think we're going to see some good trends coming up. But again, there could be some big announcement in the news that could make a big shift and push this thing out another 6 months or so. But
yeah,
if we see interest rates, if we see one more interest rate increase before the end of the year, like most are expecting, then that would suggest that we'll see rates level off for the next 6 to 7, 8 months, and then maybe we'll see a dip around this time next year. So there's a lot of money sitting on the sidelines right now, and I think as soon as we see the shift, there's going to be a ton of transaction volume that will be good for investors ultimately.
There is a ton of commercial real estate debt that's coming due at, depending on what you read, it's between like $2 and $4 trillion. I mean, it is a massive amount. Yep. And it's coming due, towards the end of this year and 2024. How are you playing that? And do you see opportunity here? And then if not, how do you think this all is going to pan out?
Yeah, so I think the question really comes back to fundamentals. Like, what are the fundamentals of the asset class, the geography, the market that you're working in? So I'm a glasses half full type of guy. I always have been, always will be. I believe that we will be okay. There are going to be some smaller operators, certainly, that are going to fall to the side, and some passive investors are going to lose some money. But I think, at the end of the day, the banks don't want these assets back. They don't want them in their balance sheet to have to operate themselves. They're not operators of office or multifamily or any of these. So I think we're going to see a lot of, I don't know exactly what the term is, like workouts or workups where they go back and negotiate with the banks.
Restructuring, and yeah.
Because I think we're going to see a lot of that. I don't think we're going to see this huge, this huge wave of defaulting loans. Like, that would be catastrophic. If we saw that happen, we would all likely have bigger things to worry about than some passive dollars we have in the market. So I think the banks are smart. Some of the smaller regional guys might get hurt on these, but the big players with good infrastructures, I think, are going to be okay. Now, I mentioned that I've been in front of the type of person I was selling to for years and years was small business owners. And back in 2008, 2009, I had, as a function of my job, I was meeting with, call it 15 to 20 different small business owners every single week throughout that downturn. And what I found was the organizations that invested in their business, held good cash reserves, had very, very good employee retention. Those were the operators that made it through the last global financial issue that we had back in 2008 to 2009. So I think we're going to see something similar this time. People that were overextended and had bad debt, I think that at some point will catch up to you, and it will likely catch up to many different players. So that kind of goes back to this idea that I like larger organizations that have good infrastructure, that have deep pockets, are well capitalized, and are investing for the future. So
you said a couple things there. Busy business owners have cash reserves on. I mean, a minimum, I like to have 8 months preferably, but really if you're getting under, 3, 4, 5 months, then, it's time to kind of sound the alarm and start making some cuts. Yep. You said to make sure you've got employee retention, because the worst thing that can happen is you having to, you lose your A players during this time period and then have to hire somebody new, right? I forget what the statistic is, but no matter what, it's pretty bad when you lose some of your A players and you've got that turnover. And then the other thing you said is make sure you're operationally sound, right? Again, success is boring. So it should be like clockwork what you're doing. I love that advice right there. So everyone's talking about the most anticipated recession of all time coming up this year. Some think it's already happened. The Wall Street Journal released an article the other day that said that, hey, based on what the stock market's done and how resilient the economy is, it's kind of behind us. What's your opinion on this? And if you don't think that it's happened yet, what steps are you taking to hedge your risks and mitigate going forward with your portfolio?
Yeah, great question. Whether it has happened or will happen, I'm not sure, as it's defined with an inverted yield curve. Many argue that it already has happened. I don't know. I'm not an economist. I know what I see in the job numbers. I know what I'm seeing with inflation. The big crazy thing is we have no idea what the Fed's going to do. They're not really following standard protocol or following logic, I don't think, at this point. So you've always got that as a wild card, like, what are they going to do? But what am I doing with my dollars is, and it kind of falls back to my strategy on what I like for businesses is I like to hold cash on the side. I like to diversify. I like to bet on big players. And that's what I've always done. And that's what I will continue to do moving forward. The old saying, like, put all your eggs in one basket and watch that basket very, very close. I don't believe that. I like to spread my dollars around, but I do like to have my buckets. Ultimately what I'm shooting towards is I want to have 3 or 4 operators, like the best of the best operators in 2 or 3 different asset classes that I'm going to trust with a large portion of my capital. And, I'm still kind of working through, I think I'm with 10 different operators right now. I would like to get that down to 3 or 4 just so I can watch them much closer. So,
okay, gotcha. And I'm curious, because it sounds like a big part of your structure is finding these world-class operators. I mean, that's what's contributed a lot to your success. What steps do you take to find and vet these operators that you want to work with? Because I can tell you're very, very careful based on how you've spoken about it on choosing who you want to work with.
Yeah. So, the classic due diligence question. The first and foremost, I love referrals to get introduced to folks, like people that I know, like, and trust. If they refer me to people, that weighs very heavily on it. Secondary, I look at track record. I like to see long-term track record where they've been at bat many times, and they've got a good record with what they've done. I like people that do the same thing over and over and over again. So, we've talked about that a little bit. And then ultimately, and kind of the one that's not maybe very measurable, but I generally won't invest or bring investor capital to a deal until I've sat on the sidelines and watched somebody for call it a year, 18 months, maybe 24 months. I think anybody can show up well on one presentation or one Zoom call or one podcast or one investor deck. But if you sit on the sidelines and you watch anybody for any length of time, they will show their true selves. And when things go bad, as they often do, or challenges come up, I like to watch and see how they respond in those situations, because that's likely how they will respond in the future if things get tough. And you know, probably more than most, that this is a very, very difficult business and things do go wrong. And if you like, a question I like to ask is just simply like, tell me the last time you had a challenge in the business, how you responded to it. It's a basic 101 interview question. And the guy that says, well, we've never had any challenges, immediately run as fast as you possibly can, right? But the people that show some creativity and some integrity and you know, just a good response to those, I think those are the good ones. I had this question came up yesterday where an operator who I've followed for like 10 plus years, he was talking about how he actually had one of his early deals go south, and over the next 7 or 8 years, he ended up paying back all of those investors that lost money initially. I would rather put money with a guy that's done something like that and made it right than somebody who's just been, you know, been playing in the game for just a few years where it's been all rainbows and unicorns. So, so it's not an easy answer. I will tell you that due diligence question is the single most important thing that listeners need to be looking at when they're considering placing their dollars. Because that's the only way you're going to find out of how good of an investment this is going to be.
I love that question. I'm going to add that because I don't ask people that. I want to ask that, you know, the last time you had a setback or some huge problem, how did you respond to it? Because that tells you everything about that person. If they paint a picture that's all sunshine and rainbows, then either you're right, they haven't been in business for very long because they haven't had an opportunity to overcome an obstacle like that, or two, they have, and they're just BSing and making stuff
right. Absolutely. Yeah.
I love that. Randy, for those that want to learn more about you, learn more about your opportunities that you have, I know you got quite a bit going on in the multifamily world. I know you're into, you know, mobile home parks. You mentioned you've got like an Airbnb fund. So it sounds like you're the king of diversification here. How do people get in touch or learn more?
Yeah, great. Thank you for that. Really, I spend the majority of my time on LinkedIn, but my website does have a lot of information. I do have an active fund that I'm raising for on the short-term rental side, which is a 506c offering. And then we always have great multifamily opportunities. So impactequity.net is the website. I do have a really cool podcast called The Gentle Art of Crushing It. I do a Thursday edition on passive investing, and then I'm always on LinkedIn as well.
Rock and roll, The Gentle Art of Crushing It. Go check it out. We'll make sure to post those links in the description. Thanks for tuning in today. Till next time.
Awesome.